Hello and welcome back to Principles of Macroeconomics. I am your host, Dr. B, and today we're going to be talking a little bit about finance, which is unusual to talk about during a economics course. But as you know, economics, finance, and accounting are somewhat related because they all talk about economic transactions. So it's important that we cover a little bit of finance in this course. And so that's what we're going to talk about today. I want to call your attention as to where we are in the classroom. So, I believe, if I'm not mistaken, we are in week, oh my goodness, we are in week not 9, not, is it, week 10, week 10, holy smokes. Goes by so fast, doesn't it? So in Module 3, Week 10, related to this chapter, we'll have a Chapter 14 quiz and a Chapter 15 homework related to unemployment. And both of those will be due on Sunday night. So first, let's talk about finance and why it's related to economics. So we look at finance because it is a large part of how people make decisions with respect to their resources over time. Throughout this course, we've been talking about supply, demand, uh, gross domestic product, all the inputs and outputs. Remember the inputs and outputs we talked about last week. This is related to finance to a degree because one of those inputs is capital. We have human capital and we have the physical capital, property, plant, and equipment. And these resources require some level of financing. And so that's why finance is an important topic to discuss in economics. The finance aspect of things also tells the business how we handle risk associated with economics. There's a couple of financial pieces I need you to understand. One is called the time value of money. The time value of money tells us the value of a dollar today in relationship to the value of a dollar in the future. Call this the time value of money. The time value of money says that the value of a dollar today is worth more than the dollar tomorrow. Can anyone tell me why that is? Why would a dollar be worth more today than it would be tomorrow or in the future? You can tell me why. About the question. Go
Because
ahead, Miss.
lose interest.
Yes, Miss Anthony. Yes, interest is a big factor of this. That's an excellent response. The value of a dollar today is worth more than the value of a dollar tomorrow. One of those reasons is interest. Another reason why that is because I can use that dollar today instead of using it later, right? I can invest that dollar, I can spend that dollar, I can do a lot more things with that dollar today than I would be able in the future. So interest and the use of the dollar is why a dollar is worth more today than it is tomorrow or some point in the future. Look at this concept called present value. This tells us the value of the dollar, what we need today in order to generate a certain amount in the future. Look at present value in a lot of different ways. Personally, you might use it in your 401k or retirement savings account. It tells you how much money you need to put into your retirement savings account today in order to generate a certain amount in the future. So if you need $1 million to retire, using the present value feature function, you can figure out how much money you need to invest today in order to have that $1 million in the future. So that's the concept behind the present value of money function. When we talk about the time value of money, we also discuss the future of money. How much money would we want to yield in the future? Call this future value, the future value of money. It's the amount of money that we would have in the future based on the amount of money we put in to the savings today. So, for example, if you wanted to have $1 million in retirement, $1 million is the future value. The future value would tell you, given the interest rate, how much money you would need to save today in order to earn the $1 million in retirement. So you can see the application of the time value of money from both a personal perspective and the business perspective. For business, we use time value of money functions in order to determine how much we would need for certain projects or for investments into the business. That's why time value of money is very important. With respect to interest, which is a large component of the time value of money, interest can be compounding. This is a fun word, compounding interest. It's a good word for a lot of us, yeah? So let's say you have $1 in your bank account, in your savings account, and you have a 10% interest rate. Well, that'd be nice, right? So what this means is at the end of 1 year, that $1 would actually be $1.10 at the end of that first year. What compounding interest is if I kept that $1.10 in the bank account for another year, I would actually yield $1.30 at the end of year 2. The word compounding means that we earn additional interest on the original balance. So if I invest $1 today and it has a 10% interest rate, at the end of the first year, that $1 becomes $1.10. If I leave the $1.10 invested, at the end of the second year, with an interest rate of 10%, I would actually have $1.30 in the bank. Why is that? Because of the laws of compounding interest. I'm adding interest on top of the interest. You see, this is what compounding interest means. Here is, I guess you could call this the formula, yeah? Here's the formula for present value. For the present value formula, we take the principal, or the present value, and the interest rate into consideration to find the future value. Present value function is used to find future value amount. So we take 1 plus the interest rate times the principal amount. It'll take us to the end of the first year. And at the end of the first year's value, we leave that in the bank. Then we add on the formula 1 plus the interest rate times 1 plus the interest rate times the face value gives us the value at the end of the second year, and then the third year, and the fourth year, etc., etc. So it's 1 plus the interest rate to the power of the number of years times the face value. That gives us the future value amount. There are a lot of calculators out there that you can use. There's present value calculators. All you got to do is just punch into a search engine. Just type in time value of money calculator. There's a lot of them. They also have them built into Excel. And or you can just get. I have here in my hand. This is a financial calculator. It's a BA2 Plus. These all have the ability to do time value of money calculations. It'll save you a lot of time instead of having to punch it out manually like this. It's just a matter of plugging in the values that you have to find the value that you need. Yep. Looking at this another example, how much would you need to put in the bank right now in order to yield $200 in the future? So we know the future value is 200 in X number of years. We use the letter N for number of years. A specific interest rate. So the present value formula would be 200, which is the future value, divided by 1 plus the interest rate to the power of the number of years. This is the present value formula. Future value divided by 1 plus the interest rate to the power of the number of years. The time value of money, we also take into consideration this concept called discounting. You either have interest or discount. Okay, interest or discount in the function, in the formula. Interest or discount. When we use discounting, it's to help us to find the present value for a future sum of money. So I need to get to goal X in terms of dollars in the future. How do I get there? By using discounting to tell us how much money we need to put in today. And here's the general formula for discounting. We take X, which is the amount we will receive in the future, so the future value. Future value divided by 1 plus the interest rate to the power of the number of years. That's the straightforward formula for present value. Using time value of money, it helps us to make decisions in business and in our personal lives. It tells us how much money we should be saving now in order to yield a certain amount in the future, like for example in your 401k or retirement plan. It also tells us in business how long it'll take us to reach a certain dollar amount to make an investment decision. There's so many different decisions that we can make with time value of money is what I'm trying to say. And it also speaks to this idea called a risk. Risk is when we risk the loss of an investment. So if I invest, for example, if I invest $1 in the stock market, okay, don't do this. If I invest $1 into the stock market, I buy a penny stock or whatever, a couple shares of some very low stock. The risk is I might lose that $1. The stock could go to zero and I lost the whole dollar. That's the risk. It's kind of like gambling, right? It's like legalized gambling. You go to the casino. The risk is you lose the bet amount. Yep. That's the risk we take. So risk is a big part of decision making. How much risk you're willing to take with your investment. For example, let's look at think of a risky investment. Oh, let's look at Tesla stock or Microsoft stock or Amazon, okay, or a large tech company. Okay, think of your favorite company, and let's say you want to buy a share of stock in that company. The amount you're willing to spend is the amount you're risking. Okay? Because it's a risk. You purchase a share of stock, the stock might go down. It also might go up. And the amount that you're willing to risk is the risk itself. Yep. So the amount you're investing is you're taking the risk that you might lose that investment. That's what I'm trying to say. People like me are very risk adverse. I don't like risk. I don't like uncertainty. So therefore, I am risk adverse. Risk adverse. I don't like risk. I don't like uncertainty. I am risk adverse. To measure risk, we must also look at a person's utility. Utility simply means how much better off will I be with this investment? It's a measure of well-being, satisfaction. Yeah, that's what utility means. How much better off will I be with this investment? So I look at risk and I look at utility. I can look at utility, how much better off I'll be with the investment, as a function. The function tells us uh, how much how much margin I can generate with a certain amount of risk. In other words, if I risk a little bit more, I might yield a little bit more. Think of it like this. Let's say you put $1 in the stock market, and that dollar you might be able to gain, we'll say 10 cents. So then you say, okay, well, what if I put $2 in? You might be able to get 20 cents. If I put $3, 30 cents, $4, 50 cents. You can see where I'm going. For every additional dollar that I put in to the investment, I might be able to yield what we call the marginal return, an additional unit of return. We call this utility of function. But it's also important to note that the law of diminishing returns still exists here. What we mean by this is that you can put a ton of money into the stock market, and the utility you gain from that additional investment will be minimal. The reason for this is people are typically happy at a certain point until they start to become unhappy or marginally happy. What I mean by this is people that are wealthy are not all that happy. And why is this? Once they reach the point of wealth where they're happiest, the additional wealth that they gain will actually make them less happy. Yeah? So diminishing returns. So look at the bell curve to understand this concept. We invest, we'll say $500. We'll say we invest $500 into the stock market. It goes up, the stock market goes up, and I end up gaining 1,000. That makes me happy. Right? If it goes down, that makes me not happy. But if it goes up, then it makes me happy. There will be a point in time where I'll still be happy, but not happier. Right? The 500 goes up to 1,000. I'm happy. If I leave it there and it keeps going up a little bit, yeah, I'll be happy, but I'm not going to be happier. Yeah? That's a part of the law of diminishing returns for utility. Insurance. Oh my goodness, insurance. We all have insurance. Well, you should have insurance. There's a lot of different insurances, you know this. There's car insurance, life insurance. Then we have a conversation about that. There's life insurance, car insurance, uh, homeowners insurance, mortgage insurance. I could keep going. Yeah, there's a ton of different insurance out there for pretty much everything. Pet insurance. Um, there's so many different ones. The idea of insurance is it protects you from risk. Protects you from risk. What I mean by this is you have car insurance because if you get into a car accident, you'll be insured. It will insure you up to a certain amount. Okay? It protects you from risk. If you have car insurance, something happens to your car, you're protected to some degree. If somebody gets hurt, you're protected. If you lose the value of the car, you're protected. The car insurance will pay, right, the part of the loss that you suffered from the situation. Insurance companies accept all or part of the risk. We call this mitigating the risk. That's what insurance is. That's why we have insurance for pretty much everything in life. The thing is, insurance is kind of a gamble. Well, it's not really a gamble, but in some cases it's part of the law, right? You have to have car insurance. It's a law. But you have to have certain insurances. It's a law. You don't have to have life insurance, but it's good to have it. Okay? You don't have to have pet insurance. It's good to have it. The concept of insurance is that you might not have a risk. I have car insurance, but I might not get into an accident. I might not need the insurance. I have to have it by law, but I might not use it ever. If I'm lucky, I'll never use it. Right? It's one of the only things in life that we pay into and we hope we never use. It's insurance. But the thing is, we pay a premium for the insurance, right? For my car insurance, for the two cars, it's like $1,800 a year. It's a premium. You know? We pay the premium to receive peace of mind. Hopefully we never use it. Insurance is like a gamble. You have it, and you hope you never use it. But if you do, it's there. Yeah. So they say, why do we have insurance? It's not to eliminate the risk. What it does is it spreads the risk more evenly. We call this mitigating. It mitigates the risk. So there's a lot of different parts of policies that you probably look into. We have high-risk people, low-risk people, and other hazards. Yeah? High-risk people. These are people that drive recklessly. Yeah? They will pay more than premiums because they drive badly. Yeah, makes sense. People that take high risk will have to pay more for the insurance. You don't wear the seatbelt, guess what? You pay more. Are you a smoker? You'll pay more for your health insurance. If you live in an area that is prone to fire, you'll pay more for your house insurance. If you live in an area that's on a fault line for earthquakes, you'll pay more in insurance. If you live in an area that's near a river, Potomac River, you'll pay more in insurance. You live in an area that's prone to flood, pay more in insurance. All these hazards. You live in an area where there's tornadoes, you'll pay more in insurance. The point is, higher the risk, the more insurance premium you pay. lower risk, the less you pay. Insurance companies usually not perfectly distinguish between high and low risk customers. Insurance companies don't know you. They know your policy number. They don't know you. Okay? Erie Insurance, they know my policy number. They don't know me. Yeah? So, because they cannot tell if I'm a bad driver or not, if I have bad habits or not, they treat me if I had risky behavior. These types of risk influence the price that we pay for the premiums. Yeah? Of course, if you've been in more than one accident in a year, better believe your insurance premium for your car is going to be very high. So, what a large insurance company does to mitigate their risk is through diversification. Do this with investing too, yeah. I've always said you never want to have all your eggs in one basket. What I mean by that is don't just buy one share of stock in one company. Oh, it's so risky, isn't it? What happens when that one company share goes down? You lose money. Yeah. This is why I said in an earlier conversation, I think it was around insurance, something to do with mutual funds. Remember this conversation? I talked about mutual funds briefly in this class. I think it was last week or the week before. Anyway, the conversation went something like this. A mutual fund has a lot of different stocks in this fund. Yeah? And they're in different sectors of the market. A little bit in tech, a little bit in health, a little bit in building materials, a little bit in whatever's retail, etc. This is a very well diversified fund. Mutual funds are. Diversification in your investing is so important, especially in today's environment. You don't want just single stocks. You want a lot of different ones in your retirement plan. Yeah. So do yourself a favor, take a look at if you have a retirement plan, 401k or whatever, take a look at it. See where it's invested. Make sure it's diversified. Don't be in just one sector. Okay. You want a lot of different ones. Diversified. This helps to mitigate the risk. What I mean by that is, with a diversified portfolio, if I am invested in a lot of different areas, one area goes down, there's a good chance the other ones did not. If one goes down and one goes up, I've diversified the risk. There's standard deviation, of course. That's why it's so important that your stock portfolio be very diverse. You want to have a large number of stocks in your portfolio. They should be all across the spectrum, right? Different sectors. What this does is it makes it less risky. Okay. If you have a small number of stocks and they're all in the same sector and they're not diversified, that is a very risky portfolio. But if you're diversified, you have a lot of different stocks, a lot of different companies, a lot of different sectors, that's very low risk. So when you come time for investing, make sure that your stock portfolio is well diversified. If you have a retirement account, you have stocks. It's really that simple, right? That's what a retirement account does. You know this. A retirement account, 401k, all it is a bunch of different funds of stocks. In most cases, you can go to wherever your retirement fund is at, and you can select the different funds. Yeah. Make sure your funds are diversified. You want to be across different sectors, different types of funds. It helps to eliminate risk. Some risks, of course, cannot be removed or limited. Uh, what I mean by this, the effects of 9/11, 2001. Nobody saw that coming, right? Or the COVID pandemic. Nobody saw that coming. And what happened to the stock market when the COVID pandemic hit? It took a very sharp nosedive. That is a risk that the market could not foresee. Okay, so diversification didn't matter in that instance. So in most cases, diversification will eliminate most risk, but there are some cases where there's market shocks like that we can simply not eliminate or limit. Specific risks apply to a single company. So if a company is at risk for whatever reason, maybe they made a bad investment, then that'll only affect that one company. Market risk is a risk to all companies in the stock market. And the best example I have is the COVID-19 pandemic. Affected the entire stock market, not just a few stocks. There are trade-offs between risk and return. I'm going to say this the simplest way I know how. The higher the risk usually yields a higher return. Lower risks usually yield lower returns. It's pretty simple. You risk more, and you get a greater return. You risk less, you get a less return. One way to think about your personal investing by age. Okay? If you're a younger person, let's say you got like 30 more years of working in front of you. Okay? You're a younger person. You can afford to be risky in your investing. If you're an older person, you're getting close to retirement, for example, you don't want to be risky. You don't want to be risky at all. You want the lower risk. Higher risk, higher return. Lower risk, lower return. But it all depends in what we say this word earlier, your level of happiness, your level of comfort. So higher risk, higher return. That's what this graph shows me. If I have all my investing in stocks only, I can probably yield a higher return, but the risk is much higher. When you do investing, I want you to look at the company's financial statements, income statement, the balance sheet, the statement of cash flows. Take a look at the company's finances before you make an investment decision to buy the shares of stock. Really important that you analyze the company's financial position. You can figure out whether stocks are undervalued, overvalued, or fairly valued. If the price of the stock is below the company's value, then it's undervalued. That usually indicates a good buy, typically. If a stock is overvalued, that means the price of the stock is greater than the company's value. If it's a fairly valued stock, then the price is the same as the company's value. Typically, stocks are either going to be under or overvalued. It's very difficult to find ones that are fairly priced. When you're looking at picking stocks, do your own research. I personally invest in companies that I know. Starbucks, Amazon, Macy's. Those are my retailers that I like. Yeah. Pharmaceuticals, AstraZeneca. construction, I usually go with Caterpillar. You know, the point is, do your research on your companies that you want to invest in. Make sure that they're in a good position. Look at what the analysts are saying about the stocks. You know, watch CNBC, the Money Channel, CNBC, Fox Business. I usually look at those two channels to kind of get a gauge of what people are saying about certain stocks. And I always recommend that when you do investing, look at mutual funds. Mutual funds, again, they're very diverse portfolios. There's a lot of different stocks in there. They're usually pretty safe, but mutual funds are usually the best instead of like single stock investing. The thing you have to keep in mind about the market is that the prices reflect all publicly available information about the value of the asset. In other words, the stock price is typically based on all publicly available information about that company. The companies are usually listed on the New York Stock Exchange, NASDAQ, or somewhere else, Dow Industrials, S&P 500. They're listed on stock exchanges. And the other thing to keep in mind is that the equilibrium of supply and demand set the market price. The more stocks that are available, the lower the price of the stock. The less stock available, the higher the price of the stock. Remember, the laws of supply and demand. Stock markets are pretty informational. They provide the prices of each stock for each available company. And they typically reflect all available information at that time. The thing that's important to understand is that the stock prices typically follow what we call a random wall. These sometimes the stock markets react on news, not information, but news. So, for example, if let's say the news is not good on that day, yeah, for whatever reason, oh, the weather's bad, oh, people are sick, whatever, the stock market's going to go down. Yeah, yeah, it's typically the stock market follows rational behavior, but it sometimes reacts negatively on news. Yeah, so the news cycles typically have an impact on the stock prices, unfortunately. Buying and selling stocks is very normal. So when you are looking at your portfolio and you want to buy and sell, that's a normal thing. Again, you want to rely on the information that's available to you before you decide to buy and sell. And always know that the price of the stock will always fluctuate. Part of that is psychological, right? Like I said, people react based on news, not necessarily information. Sometimes the price might go really high, right? Just randomly. I can think of a couple of examples. GameStop, AMC movie theaters. Yeah, their stock prices went crazy based off of speculation. It came back down. It came back to what they should have been. But yeah, it's always interesting. It's important to maintain rationality. A market can sometimes be irrational. It'll go up and down very violently without any real logic behind it. So it's important to be rational when you invest. That's the end of our discussion on investing. Stand by. We're going to talk about unemployment next.